QQQ has been the default tech ETF for over 20 years. It charges 20 cents on every $100 invested, owns the biggest names on the Nasdaq, and most retail investors own it without ever asking if there is a cheaper way. As of last month, there is, and the new version is half the price. The fund is the Global X NYSE 100 ETF, ticker NYSX. It launched on March 25th of 2026. Total expense ratio, just 9 basis points. That is roughly half the cost of QQQ and a fraction of most other large-cap technology ETFs on the market. Here's what's actually inside. NYSX tracks an index of 100 U.S.-listed technology and tech-enabled growth companies. The index pulls names from the New York Stock Exchange, NYSE American, NYSE Arca, the Nasdaq, and the Cboe BZX exchange. It is broader than a pure Nasdaq 100. You get the obvious mega-cap names you'd expect, plus tech-enabled businesses across payments, e-commerce, software, semiconductors, and digital advertising. So how is NYSX different from QQQ in practice? QQQ is restricted to companies listed only on the Nasdaq. That excludes some major tech and tech-adjacent leaders that happen to be listed on the New York Stock Exchange. NYSX opens that door. The result is a tech tilt with slightly different concentration risk, less single exchange bias, and a meaningfully lower fee. Now here's what they don't tell you. The fund is brand new and very small. As of recent data, total assets under management are only a few $1,000,000. That is a problem for two reasons. First, low AUM ETFs sometimes have wider bid-ask spreads, which cost you money on every trade. Second, very small funds occasionally close down if they fail to attract enough assets in the first year or two. That is not a forecast, but it is a real risk to underwrite. There is also a track record gap. QQQ has decades of performance data through multiple bull markets, drawdowns, and tech cycles. NYSX has weeks. You are essentially betting that a new index, with a new constituency rule, will deliver tech exposure at least as good as the most established competitor in the category. We will not know if that bet pays off for years. The thesis still has appeal. If Global X attracts assets, this could become the lowest-cost diversified tech ETF on the market. 9 basis points compounded over 30 years is meaningful. On a $100,000 portfolio, that fee gap saves you tens of thousands of dollars in pure expense ratio before any return difference. So who is this fund for? It's for cost-sensitive long-term investors who want broad U.S. tech exposure, who are willing to use a brand new fund, and who can keep a portion of their tech allocation in something other than QQQ for diversification. It is not a satellite. It is a potential core tech holding, if you trust the structure. One honest reality check. Lower fee does not automatically mean better outcome. The QQQ ecosystem has deep liquidity, options activity, and institutional adoption. NYSX is starting from zero. That asymmetry matters in execution, even if it does not matter in long-term compounding. If this breakdown helped you, hit like, subscribe, and tell me in the comments. Would you switch your tech ETF allocation from QQQ to NYSX for a 9 basis point fee, or do you stick with what's proven? I read every comment, and the best ones shape the next video.